All right, guys. So today I am here with David Jaffe of BestStockStrategy.com. So he's kindly just like agreed to sit down with us and discuss his option selling strategy, which is awesome because of all the services that I've reviewed over the last probably 5 years, I don't think any of the owners of these services have agreed to sit down one-on-one and discuss all the details, openly and transparently. And that's been my experience with David since I met him. And I joined his service probably 6 months ago, maybe a bit longer. And I did a month, and I found the service to be absolutely excellent. Not for me because I'm so busy with other things that I don't have time to juggle all these different services. But if you want to start selling options premium, it's the best service that I've found out there. So my background's mainly been in selling stocks, and I really feel like David got me into selling options premium. Up until I met him, I had no idea like what option selling premium was. And to be honest, I was skeptical looking at his website because coming from a stock trading background, I'd see these win rates of 98, 100% win rate. And I was just sitting there going, this can't be true. This is not right. But after joining the service and looking into it a little bit more, I fully understand the system that he uses. And that's kind of what I want to talk to him about today. So welcome. Thank you very much for getting me into option selling premium. And I was hoping you could give me a little bit of background from where you got started and how you settled on this option selling strategy. It'd be awesome.
Yeah, definitely. I graduated from an Ivy League school, which I know I kind of regret now going to college because a lot of what I actually learned, it cost me 4 years of time. It was also really expensive, and I don't really think that it helps me a lot right now. Then I worked on Wall Street as an investment banker, where I think that the biggest takeaway for me were some of the relationships that I made. And additionally, I know that a lot of people point the finger at Wall Street and they say that Wall Street like manipulated the market or did things like that. And I think that the biggest takeaway that I had from working as an investment banker was that people give Wall Street investment banks and bankers significantly more credit than they should, at least on an individual level, like perhaps acting in aggregate like they did in like 2008 with the commercial mortgage-backed security. Like that led to a lot of problems. But I think overall, like on a day-to-day basis, people point the finger and blame Wall Street significantly more than they should. Secondarily, I was trading throughout like college and trying different strategies, trying to learn like technical analysis and all these different things. And I started settling on option premium just because I felt like if I'm going to go long these large cap stocks that I wanted to own anyway, like Google or Amazon, then I might as well collect premium and and agree to buy them at a lower price. So that was pretty much like the impetus behind it. And then once I started like changing the strategy a little bit, this was before Tasty Trade came out, and I kind of like learned from experience. I think the biggest thing that I learned was when I initially started, I was trading too aggressively. And similar to something that you said in the introduction, where about the win rates, you can definitely have like a 98% win rate if you sell something that's so far out of the money. Right. The problem that people have, especially when you have a smaller account, is that you are going to end up using a significant amount of buying power when you sell something so far out of the money. And you have to get the win rate pretty spot on, because if you try for too high of a win rate and you have a smaller account and you're only making like 0.5% or like 1% a month, then it really doesn't make sense for you to even sell options. Like in that case, you might as well just buy the SPY and sell covered calls against it. So I wouldn't necessarily look at the win rate as an indictment against the strategy. Rather, you have to give and take to make sure that you're setting up your trades and structuring your trades correctly, and that you're selling the right strike, and you're deciding whether to sell naked options or vertical credit spreads, etc.
Yeah, so I've only had experience doing some basic selling puts, basically, and a few covered call stuff. So I agree. So maybe we give a quick overview just of what, in case somebody's watching this and they're like, what the hell is selling options? Because let's face it, most people don't try this strategy for many, many years. At least I didn't. So the basic overview is you're trying to stack the odds in your favor, right? You're being like an insurance broker. you're doing bets, but the bets are so heavily, at least statistically, in your favor that you have a really, really high chance of winning a small amount of money, right? That's the basic premise of selling options. Because of the idea that these options expire worthless 80% of the time, that you're going far out of the money in order to basically almost be sure that you're going to win at least a small amount of premium, and you're getting that premium up front, right? That's what, so it's like considered like passive income. One question I had for you though is like, it's passive income, but how is it more passive than just swing trading stocks, for example? Because you buy a stock, it goes up in value, you've got that money in your account. That's passive income as well, right? It's just
Yeah.
riskier passive income, maybe.
Yeah, I'm not sure if it's necessarily passive income, because the way that I look at passive income is kind of like you put a trade on and then you forget it. You forget about it and then you earn. Passive income is kind of like putting money in the bank and then you get a interest rate and then you kind of set it and forget it. I guess you can look at it like passive income would be if you sold something that's like so far out of the money and then there was an assumption that that trade was like guaranteed, which it's not, because even when you sell options, there are like a certain percentage of your trades that are going to get challenged. So
Right.
I think when people talk about passive, they look about, or they're speaking about guaranteed, whereas with swing trading or even with buying and holding, even if you buy something like Amazon, recently over the past month, I think Amazon's 52-week high is like 37.73, and then recently, like on Friday, it closed around like 32.50 or something. So even that has gone down. So I think if you compare it to passive income, I think people are looking more for guarantees. So perhaps selling options would be more passive because the win rate is higher. But I still wouldn't necessarily characterize it as passive income, because you still have to like identify which underlying you want to sell an option on, the strike selection, etc. And then when that option expires or you buy it back, you'd have to resell it.
Right, and I know if when I was in your service, you were holding stuff for a while, but there was also times where if you got that win quickly, it would be a day trade, right? Occasionally, I saw day trades, so it's like, it's pretty cool. You do some short ones, some longer holds, and that'll come up again in the questions from some of the guys that are looking to maybe subscribe to your service in a bit. So let me see. So beststockstrategy.com. Yeah.
Let me briefly touch upon that, and just because I think I can add a little value on like the reason is, so let's say we put a trade on, and let's say we think a stock is oversold, then we are then going to sell a put option, and let's say we sell a put option for, let's say, 4 weeks out. If we get lucky and that stock just basically has like a V-shaped bottom and it just turns around and we kind of like nail the bottom, then in that situation, let's say in like a day or a few hours, we've realized like 30%, we've captured 30% of the premium. And if we sold that position for $1, but then we can buy it back at like 70 or like 65 cents after just like a day. In that situation, I'm almost always going to close out that position, because I've been able to realize like 30 to 35% of the profit in just like a few percent of it, in like 5% of the time. So in that situation, it's in your advantage to close it out early.
So you're churning it and compounding it to try and, yeah, and that's what I've been doing with the smaller cap stocks that I've been selling puts on, is I rarely wait that long. So the goal with my strategy is to close out about 50 when you have about 50%, but that can take a week or two. But if I get 5-10% in the space of a day or two, I'll take it and I'll roll it. Well, not roll it, but I'll do another trade with it. So I know it's a riskier strategy than yours, because from my understanding, you tend to go for higher price stocks like Tesla and things like that. So there seems to be a lot of pros and cons to that in terms of people with smaller accounts, which keeps coming up whenever I talk to people about this stuff. So we should touch on that a bit as well.
Sure.
But first of all, like, I remember reading through some blogs and seeing some of these posts where people are arguing about your track record, and you're one of the most transparent traders I've ever seen. You're posting your brokerage accounts for years, it looks like. On your website, there's like statements, there's like all this stuff, like mountains of it. And I came across this website, and there's this guy just arguing nonstop. You cannot have made 100% of your trades this year. And it got into all the legs of spreads and like all this stuff. But I've been telling people that I've never seen anybody put as much effort into showing that they're legitimately trading these things as you have. So that's a really, really cool selling point that you've got on your service. That's for sure. So I really like that.
I think when you trade options, a lot of it is nuance and a lot of it has to do with experience, because you can win like 90, 95, 98% of your trades. I think one of the major things is when you do have a challenge position, you have to get experience with how you're going to feel about that. Are you going to be like really stressed out? Or are you going to feel like, okay, like no problem, I'll find a way to take care of it? Or, you know, in something that doesn't happen that often, you might have to close out that position for a loss. I think that when I used to post my larger statements, but then what would happen was that people would then be under the impression that you needed a really large account in order to trade options. So then I did like a small account challenge where I grew like a smaller account from about like 5,000, I think, to over 10,000 or something. The statement is there, and I think that is still up. I saw that thread. I think that individual who made the comments were confused because I was using, because I had a smaller account, I had to use vertical credit spreads. So what happens is that when you put a position on as a spread, you are able to use more buying power. But every time that you buy that option on a theoretical basis, or actually like on an actual basis, you're going to end up losing money on the long option that you use as protection, because that's going to enable you to increase your sizing and also use less buying power. But that position was put on as a spread, as a net credit, meaning that you're collecting money. So on a net basis for that spread, you're making money. But if you look at the individual trade on the individual leg for the long option, then yeah, you're going to lose money on that long option because you're using it as insurance and to increase your buying power.
Yeah. And with this 98% or 95% win rate, I learned the hard way recently. So I've been doing a lot of, in fact, I've really only been doing selling options recently. So I started selling, basically won like 30 trades in a row. And I was like, wow, this is the way. Then I lost one trade, and I don't have the experience that you have. And it wiped out my previous 30 trades, and I'm down. I'm trading really small with it because I'm new, so it's not a big deal. And I remember you told me, I think just a week ago or something, you said, just be careful of those 5% of trades that don't work. So the problem I'm having is I don't know how to get out of it. I'm stuck, you know. So I managed to get some of my losses back by resorting back to my day trading. So I'll basically buy some shares at technical support. I'll dig myself out as soon as it goes up. I'll take some profit, and I'm digging my way out. Trying to do that, but I've been assigned the shares now, so I'm just like, this is not so good. So now I was so excited about this strategy, and it's not the same strategy that you're doing. It's on small cap stocks, so not as safe, right? But I'm sitting there going, do I want to continue this? Because I don't have the skills, and I think that's where you come in, right? I mean, you're known for being able to get out of these trades, these one or two trades, without suffering huge losses or even turning them into gains. So have you got a few comments on like what you tend to do? And I know it'll be trade dependent, but what you tend to do in order to escape the bigger losses?
Okay. This might be hard for me to communicate because a lot of it is based upon nuance. I feel like I'm always a student of trying to learn and like look back and analyze like what I did wrong and how I can improve. When I think of the answer to this question, there are some things that I guess I've learned like over the past 5 or 6 years where I made expensive mistakes and then I've learned from them. So we can touch upon those. Although I think it might be at a higher level, because each individual trade that's challenged, you can then run yourself through like questions like, has the situation changed? Like with the stock, are you still bullish on it? Are you still bearish if you sold the call, etc.? So let me try to help and go through some of those. So I think the first thing that you can do is not to get too comfortable or not to get too confident. So in your situation, if you potentially won like 30 straight trades, you should then reflect back and say, okay, did you think that this was like quote unquote easy money? And were you more aggressive with your 31st trade than you were with your first trade, which could have potentially got you into trouble more so than it should have. So that by far is the most important, because if you can avoid a problem, then you're going to save yourself a lot of stress and then also save yourself money. The second thing that you should ask yourself is, did you trade this as a naked option or as a vertical credit spread? And then I'll briefly go through each of those scenarios. It's easier to roll a naked option because if you roll something, if you put on an initial position as naked, then you only have one leg to roll. And then additionally, what I like to do is I always try to be like too early as opposed to too late. So let's say I sold something in, let's say like $150 stock, so like XYZ. And let's say XYZ like a month ago was trading at $220, and then 2 weeks ago it was trading at like 190, so it fell from 220 to 190. And then I felt that it would be good to sell a put option on this individual stock at like 160. Actually, something similar to this. Yeah, like something similar to this exact scenario. So let's say Alibaba, which actually has like similar price action like over the past month or so. Okay, so let's say you sold like Alibaba, you sold like $160 put, and I think Alibaba traded on Friday around like 158 or something. So that's where it closed. In that situation with Alibaba, I would have, I still think that Alibaba personally is oversold, but it could go down all the way. You know, we don't know how far it can go down. If I was short a 160 put, I would have, when Alibaba hit around 165, I would have tried to roll that position down as far as possible. So what many people do when they roll is they look at it as an opportunity to profit, and then they will increase their time to expiration, and then they'll see, wow, I can sell the same 160 strike price for 2 months out and collect a ton of premium. I don't want to give up that money that it's paying me, and I'm going to take that premium. To me, I think that that's a massive mistake, because even if you were to collect, like, let's say $7 a premium to roll the 160 Alibaba put from the current month until, let's say, November, if you allocated that premium towards reducing the strike price, then instead of collecting just $7 or $700 per contract, you can probably reduce the strike price all the way down from 160 to 140. So anytime a position is challenged, your first goal is to minimize risk and minimize losses and get rid of that position. You should not be thinking like, okay, I can now pick up an extra $700, but I'm going to keep the strike price the same. No, I would take that premium, that $700, and then roll it all the way down to 140. Okay. Then, if let's say Alibaba falls to about like 140, we're still on nakeds. What I would potentially do is, and I felt like Alibaba, I was still very bullish on it. I wanted to, I still believed in the stock. I thought that it was going to go up, and I thought that it was massively oversold. And I still wanted to like protect my downside. In that situation, if the 140 ended up getting challenged, what I might actually do, if I didn't want to roll it again, I might actually roll it additional months in time. I might buy, let's say Alibaba was then trading, like it fell all the way down to like 145. In that situation, I might actually buy a 140 or 145 put, and then I might actually roll my existing in the money put to have it like, or rather not my in the money put, I might actually roll the existing short put to be in the money. So I might actually increase the strike price and increase that short put to maybe be like 165. So that way I can collect both intrinsic premium and extrinsic premium while also minimizing my downside risk, because I bought an option. So I would then convert that naked option into a vertical credit spread. So therefore my downside is capped. And I'm also participating in the upside of the stock, because I would feel that Alibaba was vastly oversold, and that I would think that there's a high likelihood that it's going to increase in price. And then as the cherry on top, I might actually sell short dated calls against it with a strike price of, let's say, if Alibaba was trading at like 145 in that example. Typically, if something is like vastly oversold, it has a tendency to snap back relatively rapidly. So I don't want to sell a call option that's too close to the current market price. But I would be okay with selling like short dated calls like 2 weeks out and selling them with a strike of about like 165 or like 170, and then waiting for that to expire. And even if that trade got challenged, I would be completely okay with it, because I would be making money from that short in the money put. And then if the short call got challenged, I would just close out the entire position for a profit anyway. Now now that's a good example of kind of minimizing your risk, because what typically happens when you're short a naked put and the market is crashing, there's like a lot of fear. Like even legitimate companies, you're scared that, oh my God, Alibaba, its 52-week high is about like 320 around, and now it's trading at like 140. So this thing's what happens if it trades down to $50? But by turning that into a spread, your maximum loss is just going to be the premium that you paid for that 140 or 145 put. And then you can actually potentially make that back just by selling short dated calls against it. So at a worst case scenario, even if you don't make money and Alibaba continues to fall, you're still eating back some of the premium that you paid on that long option by selling short dated calls against it. Now for spreads, they're like a little bit more difficult to roll, because you have that long put option, which is acting kind of like an anchor, like, so going back to the example that we used, if Alibaba starts trading at like 165 and you're short like the 160, and then I gave the example where that option will be trading like $7 a share or $700 per contract. When you're short a vertical credit spread, you're already protected. So your maximum loss is just going to be the width of the strikes. Right. So as a result, it's much harder for you to roll that position at 160 by all the way down to 140. You wouldn't be able to do that. Instead, what I found to be the best bet for vertical credit spreads when a position gets challenged is you actually roll up the long put option. And I'm focusing on puts, but the same logic goes on when you're short a call. So let's say you were short like a 160 and you were long the 150 vertical credit spread. Now, what you could do, you could roll that forward by like 2 or 3 months, and then maybe you could decrease the strike from 160 by 150 to like 155 to 145. But that's not like it's not like a super material change, right? Like you're giving up 3 months, but you're only rolling it down by like $5. I mean, that's not really like that much. Instead, what I like to do is I like to reduce my max loss and try to cut it in half. So I would try to roll up the 150 all the way to 155. And the reason is that if you try to roll the 160 down to 155, it's actually significantly more expensive than it is to roll up the 150 to 155. It's much less expensive. And then, so you can use time value by rolling it forward by like 3 months in order to collect the premium to increase and allocate that premium to increase it from 150 to 155. Additionally, you can, like I said before, you can sell calls against it. And additionally, if you wanted to, what you could do with spreads, if you had $10 wide and you really wanted to like decrease the strikes, you can actually widen out the strikes to about $15 and then use that. So you're increasing your max risk by 50% from $10 to $15, but you're collecting more premium. And in that situation, then you could actually roll down the spread, because the spread's almost like a box, right? Like it's a box, like, okay, it's $10 wide. So it doesn't matter if it's like 160 by 150 or, 130 by 120, et cetera. But, if you want to roll it down from 160, the short put from 160 all the way down to like 130, it's going to cost you money because the 160 is so much closer to the current market price, and it's trading for more money because your maximum loss on that 160 is going to be $160 versus like the $130, et cetera. But if you wanted to roll it down from 160 to 130, you would probably have to expand the width of the strikes from 130 to rather, it would have to be, you would be short the 130 and then long the 115. So in order to do that, if you wanted to roll it down, you'd have to expand the width of the strikes from, let's say, or expand the width of the spread. So instead of being $10, it will be 15, and then you can roll it down to like, 135 to 120 or like something like that. And then finally, similar to what we did with the naked option and rolling it into a spread, if you did feel that Alibaba was significantly oversold in that long term, it's going to increase in price, then you could just simply flip the position similar to what we did with the naked option and converting that into a spread. And you can simply roll up the long put to about 160, and then you could sell an in the money put. So you would roll up the 160 short put to about like 180 or 185, and you would collect a lot of premium on that because the 185 has both intrinsic and extrinsic. And then you can sell short dated calls against that as well.
Wow. That is an awesome explanation. I think that's why people want to join your service, because I don't think most people can handle that kind of stuff by themselves. But if that's the type of information you're providing them in that kind of like obviously you're absolute pro at that. If people are getting that in your service, there's no, I mean, how could they not, right? They're going to love that. That's just crazy. Awesome. What an explanation. And
I will say though, sorry to interrupt. Some people though, they do get enamored by like the win rate, but they think that they're going to win like 100% of their trades with like no stress at all. But that's not how it is. And I do really think that dealing with stress or like challenge positions is something that comes with time. Like, it comes with experience. Like once you've had like 10 positions get challenged and you've pretty much like made money on almost all of them, and like maybe a few of them you kind of like scratched for like, either a small tiny loser or like no money, etc. Then you're like, okay, like this is no different. I have confidence in my skills, so this is really no different than the other times, and everything's going to be fine. But until you actually experience that, it's hard not to like freak out. And especially when you have a position being challenged, then usually that means that other positions are being challenged, because it means that like the market has corrected. So, you're kind of hit with like a double whammy. And then also what a lot of people don't realize is that the expansion and volatility is usually your biggest enemy. So an option does not necessarily have to be challenged or even close to challenged, right? Like you can still have an option be like very far out of the money. But if you've had a massive volatility expansion event, then you could find yourself like running out of buying power, just simply because even this past week, I think the VIX increased from the low and the high for the week. It was about 15 at the low, and then I think it hit a high of like 24.72 or 24.78. That's like a 60% increase in just a week. And I know that it closed, it didn't look that much, because if you compare like the opening on Monday to the closing on Friday, VIX increased, but not like tremendously. But intra week, there was like from a high to a low about 60%, which is a lot. And your broker can force you to close out positions because they can change like the margin requirements at pretty much any time.
Cool. So I know what your track record is roughly from looking over brokerage statements and talking to you. How have you done this year so far? It's been a tough year for a lot of people. What are you at roughly? Just rough number. Just roughly, are you up 10%, 50%? Like, what's your kind of portfolio
this
at?
Year, I think we're up about like somewhere between 28 and like 32, like something like that. This year we've done really well in the beginning months, because besides like this past week aside, volatility for like the first 6 months was elevated above 20. So when the VIX is high, that means that there's a lot of fear. So then you collect a decent amount of premium. It is really, really hard to sell options when the VIX is trading around like 15. It's just really, really hard, because you're not collecting a lot of money. And then also when the VIX is really low, stocks tend to be going up. So I kind of have like a rule of thumb where anytime long equity holders are able to make more money than option sellers, I'm really scared for a correction and a crash. And I remember in January 2020, and for the first half of February, like the market was just going up like all the time, and it was just really difficult for me to find trades. And I think that during the past few months, when the VIX has been for the most part trading below 20, option sellers really have to temper their expectations, because when the VIX is high, you can make, if you're trading like the way that I like to trade, I was making about 4 to 4.5% per month. But then over the past few months, when you have low volatility and therefore you're collecting less premium for every trade that you're making, I think making about like sometimes as low as like 1.5 to like 2% a month, and that's hard for people to swallow that. But I try to target an average return or a median return, whatever, average or median, like etc., of about like 3%, and it tends to work that way. On average, because when volatility is high, you're going to be making more, and when volatility is low, you're going to be making less. But I think that a lot of people they might not be patient, and they want to see like huge returns. But it's very important to temper your expectations with volatility, because if VIX is low, it's kind of like if you decide to sell insurance, if you decide to sell hurricane insurance in Canada, you're going to need a lot of customers, because the amount of premium that you're going to collect is going to be very low. Right. But if you're going to open up a business and sell hurricane insurance in Miami or South Florida, you don't need as many customers to make just as much money, because the amount of premium that you're collecting is going to be significantly higher.
That's a good analogy. Yeah, I like that. So let's delve into your strategy really quick. So I think I understand some of it, the basics. So you're looking at these larger cap stocks. It sounds like you look for oversold bounces and then sell puts on those. I was talking to, I think you saw Charlene's interview that we did a few days ago. I think it was her that mentioned that you don't seem to look at or talk about the Greeks much. So which I thought was kind of interesting, because the way I've been doing it is looking at time decay, like it's the first initial thing. What do you do with that stuff? I'm curious, like, do you look more at the technical charts and forget about time decay, or do you factor like the volatility and delta and all that stuff in, or like what's your kind of basics on that?
Yeah, that's a great question. And I think a lot of people, they use like technical analysis or Greeks because they want affirmation and they want to be guided. And they also, some people, they might not feel comfortable like making a decision unless everything lines up like with their checklist. So they go through things. I think the issue with having a checklist is that oftentimes in the short term, the prices tend to be irrational, and human behavior also tends to be irrational in the short term. And I feel that the markets are guided by short-term behavioral swings. Like long-term, the prices tend to be pretty accurate, but short-term prices can be highly inaccurate. So what I like to do is just keep things almost as like a simpleton. And I ask myself, I want to sell on the put side the highest strike that I don't believe is going to get challenged. Right. And I also want to collect as much premium. So I look at the premium at the price, because the current market price of the option encapsulates everything. It encapsulates like implied volatility rank, like the expectation of the future move, the expectation for the market, everything. And I just simply ask myself, do I believe I'm receiving enough money to compensate me for my perception of the risk that I'm taking? And if the answer is yes, then I'll make that trade. If the answer is no, then I won't make the trade. And perhaps that comes from experience. I do though. I will glance, maybe like once a day, I'll glance at like the the biggest gainers by price and the biggest losers by price. So I'll look at those, and then I'll also glance at Tastyworks has a list of like stocks based upon like IVR. The problem with the biggest gainers, the biggest losers, and the IVR is that most of those stocks tend to be, I wouldn't necessarily say like micro cap, but they'll tend to be stocks that I
Right.
don't necessarily feel like super
Right.
comfortable, but they tend to be like more risky.
Yeah.
So I think I can trade the same way, and I would make the same trades. I think I would make 95, 90, or 98% of the same trades without looking or scanning those. But I also want to be informed, you know, so I do want to make sure that like I do check those lists like on a daily basis, just to make sure that I'm not like missing out on an opportunity. Like what's something where like a recent, okay, so I think on Thursday or Friday I made a trade on like Robinhood, because Robinhood like fell, and then I saw that it had like pretty high IVR. So I was like, okay, I wouldn't mind owning Robinhood. I know it's a legitimate company. It's a lot smaller than the typical company that I like. I think it only has a market cap of about like 75 or 80 billion. But I was like, okay, I can sell a put on Robinhood with a strike price of like 25, and I can go out like 60 days in time, because one, it's only $25, so there's like virtually no max risk on this. And I really don't care if it gets challenged, because like one, I can manage it. And even in the worst case scenario, if I get assigned, which like rarely ever happens, but I don't even mind owning it at like $25, right? So it's like, so I will occasionally scan those, but a lot of it is just done by asking myself, do I feel comfortable with the strike price? And do I feel that I'm being compensated enough to make this trade?
Trade. That answers quite a lot of the questions that some of the guys asked me to ask you. There's a couple other ones here that we could use to kind of finish off with. So one guy asked me, why do you go so far out of the money apart from the high probability of getting a profit? All the back testing that he's done in his system shows that you don't want to go quite as far as that if you're trying to get income. So he's saying that 0.1 to 0.15 delta seems to be the optimum if you're looking for selling puts to get the income. And then 0.3 delta for wheeling a stock. And I know nothing about wheeling. I haven't got that far yet. So do you have any comments on that? Maybe we've covered that already, actually, kind of in what you were saying.
Yeah, definitely. I think that the reason why I go so far out is one, I'm naturally contrarian. So I'm actually receiving a decent amount of premium, even though I go far out, because typically I'm going to sell something that is far out of the money on a stock that's already fallen. So as a result, the implied volatility rank on that stock tends to be pretty high. So I'm receiving a decent amount of premium, even though I'm going further, or even though I'm going and selling something that's further out of the money, because there is fear in that security. So
Right.
I'm targeting something that has fallen and that's already paying more money, but I'm just being like a little extra careful and going further out. The second thing, and I think that this is the better answer to that question, is people have a tendency to have like loss aversion, where if I like if you lost $50, you would need to make like, I think the last scientific study I read, it was 4 times as much. And actually, I think this was confirmed by like a recent podcast that I listened to on like NPR, where it said you'd have to make like $200 in order to have like equilibrium between the pain of the loss and the feeling good of making that money. As a result, like I'm completely okay with making less money. I just want less stress. Like I really don't want to deal with like challenge positions. And here's a good example. And this example is probably self-serving because it just worked out like really well. But a few weeks ago, Amazon reported earnings and they fell. At one point, they were down like $280, and I think it closed that day down like $230 or something. And I was short puts below like 3,100. And if I traded more aggressively, like 33 or 33.50, I would have lost money on that position. And in the beginning of the day, on I think it was like Thursday or Friday, I forget which day that they reported. I think they reported on Thursday or something. But on Friday in the morning, when there was like a ton of fear around Amazon, I would have shown like a pretty big loss on that position if I had traded like 3350 or 3300. But instead, because I chose to trade like the 3050 or like the 3100, I had a plan in place. And remember, that move by Amazon was like twice the expected move. And I wasn't stressed out. Like, I don't think any of my students were like stressed out. I think I sent a message to them saying, okay, if Amazon falls below like 3200, then this is what we'll do. We'll end up rolling it. But I just don't want to, I'd rather make less money and deal with less stress. I just
I
don't,
agree.
that's
I
my
agree.
personal preference.
Yeah, me too, and that's why I'm trying to switch to this type of strategy, because for a long time I was just doing like scalping stocks, like waiting for alert services to put alerts out, buying in with like 100 grand, getting a few percent each, and being done for the day. This is less stressful, and that wasn't particularly stressful, to be honest. So, looking here, so somebody asked about strategies for managing trades. I think we've covered that pretty much in detail from a few minutes ago, so we don't have to go over that again. How he avoids big losses that could wipe out all the winnings. We've covered that as well. It's the same question, I think.
It's definitely true. I'm always scared to death about like big losses, and the problem with trading options is because I hear stories about like, oh, it's like picking up like pennies in front of a bulldozer, and I think I do think that has some validity to it if you're trading too aggressively and you're trading too big. But if you're not trading too aggressively, then there's really, from a risk perspective, there's really no there's no scenario where selling something that's pretty far out of the money, where you have the buying power and it's a legitimate company, is less risky than buying a stock outright. Like if you believe Amazon and you sell a put option for 2,500, that's not picking up a penny in front of a bulldozer when Amazon is trading at 3,300. It's less risky. The thing that makes it more risky is the leverage. And that's why you have to make sure that you're comfortable with the buying power reduction on every trade that you make. You're comfortable with the amount of premium that you're collecting. You're comfortable with the number of contracts, etc. So that's the bigger issue. It's usually always a size issue.
Yeah, definitely. And then so other questions were, how does he scan for trades? I think we covered that basically, right? Average hold time. When I was a member of your service, it seemed to vary quite a bit. I saw the odd day trade, the odd few days, maybe like a week. Is that kind of what we're seeing?
I would say the average hold, that's pretty rare that we would close out a trade after like a day or two. I would say the average hold time, when you factor in like closing out trades early, and then we do sometimes hold some trades to expiration, I would say it's about 2.5 weeks. I'm just ballparking it, like estimating it.
Cool. And then another big fear that people seem to have about your service is, how many open trades are you going at the moment? Like, well, not at the moment, but like on average, are you holding like, because I know they tell me that you say to have like 40% in cash so that you can manage these odd bad trades. But like, how many do you have? 10 on, 20 on at one time? Like, what's your thing?
I usually have positions in about like, I try to have about 4 or 5 underlyings, and within those underlyings, maybe I'll have like two trades on. If you were to have a smaller account, I would say that you should be more concentrated. So that kind of like flies in the face of like conventional wisdom. I think that for people with smaller accounts, it's advantageous to them to concentrate their portfolio in the best trades possible. So if you have high conviction on something, then I completely think it's okay. And I know that I'm probably going to get grilled for this, but I'm just telling you from my experience, like if I traded even more concentrated and focused on the best opportunities, I would have more money than I have now. Because sometimes especially when the volatility is low and I'm searching for trades, like for example, Zillow fell like a few weeks ago, and then we sold like a 90 put option. And actually this past week, and I know that on Friday, Zillow closed above 95, but there was a time intraday where Zillow fell below 90 to about 89 something. And I actually had to roll out that position from like 90 to 80. So I think that I tend to get in trouble when there aren't that many positions on and I'm like scanning for trades, like I said earlier, and I'm just looking for something to trade. But I do think that to answer the question, if you have a smaller account, it, from my experience, is more advantageous to focus on maybe like two securities that you have high conviction on, and and just leave it at that. And also, when you only have like positions on two securities, it's easier to manage those positions if the position were ever to get challenged, because if you have like 10 positions on and then there's some correlation in risk, right? Because if the market goes down, then it tends to like go down, like a lot of positions tend to get challenged. So in that situation, it can become a little bit overwhelming. And I think that not enough people focus on like the mental aspect of trading, because you can get like really stressed out and overwhelmed when you have like 10 positions that are like in the money.
Right, exactly. And I guess like a lot of people like, so when I was in your service, what I liked is you gave grades. Like you actually said like this is an A or a B. I don't know if you still do that, but it was helpful because people with limited buying power could be like, okay, I'll go and check that one out. And there's usually not a rush to get in, which is awesome, right? So you can go and you can do your own due diligence. David says it's an A. I trust his experience. Let me look at the charts. Let me look, do my own thing. Am I comfortable with it? Okay, I'm putting some of my capital into that trade. And that's different from a lot of these crazy crackhead day trading systems and stuff where you do that, you're screwed. You won't get the trade, So I like that with your service. Like, yeah.
I'm actually usually early, unfortunately, and
that's what people tell me.
So, I'm trying to work on that. I'm trying to like trade later in the day. I do think that having the alerts, like sometimes it puts me at a disadvantage, because I do feel like a little bit of like performance anxiety, like, oh, I need to make a trade or something, where if I didn't have the alerts, my performance would actually probably be better. And I do feel that that the students who wait on the alerts overall in totality, they actually do better by waiting until like later in the day and things like that. And that's why I think, like, I have some students from like Australia and New Zealand, and they usually always trade like either the first half hour or like the last half hour, and they do really well, because it's like it's not very stressful, and they just log in and they're like, okay, they scan it, they're like, oh, these are the trades, oh great, okay, I'll make this trade, and then they forget about it.
So the first half hour tends to be higher volatility, right? That's at least on the smaller stuff I've been doing. Do you aim for that at all? Do you ever try and like time your entries for the early open kind of thing to get that spike, or do your stocks, like the higher price ones, not really get that same volatility spike?
Yeah, that's a great question. Okay, so in the morning, you do tend to receive slightly more premium. So for example, I think like, let's say I were to sell Amazon, or let's say I were to sell like MasterCard, and let's say MasterCard was down like $2 in the morning, and I sold a put on it. And then in the evening, Amazon, like in the afternoon, Amazon, or why do I keep saying that? Amazon, MasterCard was down $3. You might have actually received more premium for selling a put on MasterCard in the morning than you did in the afternoon, even though MasterCard was down an extra dollar. So I am slightly cognizant of that, and I think that might be part of the reason why I'm a little bit more aggressive in the morning. But I think to summarize, I think I'm actually doing myself a disservice by being aggressive in the morning. And I think that overall, I would be better served if I was more patient and waited for the afternoon to make the trades. And the reason for that is, while it is rare, there are like a few times where the market just collapses in the evening. And especially when we were talking about the perception of like picking up pennies like in front of a bulldozer or something, like during those major sell-offs after 2 p.m. Eastern, or like 2 hours before the market closes, that's when the market tends to like sell off tremendously. And I think that especially when you're scared about a bear market, or when there's a bear market, that's when you really, really have to be disciplined. And that is actually one thing that I do. Like, I remember this past week, I really didn't make any trades like in the morning. I was just like, okay, we're waiting until the afternoon. Let's see how things progress. Because when there is a sell-off, and there's a big sell-off, there does tend to be a situation where the market will open up, and then around 2 hours before it closes, there'll be like a huge sell-off, and then there'll be a massive volatility spike as well.
Cool. So I have a few more questions. I think we're getting towards the end of a reasonable length of a video. I think I have 4 or 5 more questions. They shouldn't be too long, though, to answer. So first of all, people are asking about how you do the alerts, and I told them WhatsApp. You send out the WhatsApp stream. Really nice and simple. There's like, it's not text or email, just boom, 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 and it's really good. So I don't think we need to talk much about that. One person's asked, what's the worst loss that you've ever been able to get out of, and what would you have done differently to either avoid the loss or to minimize it? So I think they're looking for a number there. So I don't know if you want to give a number, like 50 grand loss that you somehow brought back, or if that's not something you're comfortable sharing. What's your thoughts?
Oh no, I'll share it. I mean, I remember, and I think I have a video about it, like in February. Okay, so this is really funny. Well, it's obviously not funny to lose money, but okay, so I remember this. It was February 5th, 2018, and I believe it was a Friday. And what happened was, and this is like getting like kind of personal, but so my wife wanted to see her mother, so I actually flew my wife's mother from her native country to Colombia. So we went to like Cartagena, and then we were like in Miami, and we had a flight at about like 12:30. And then I remember receiving, because the Thursday, like the day before that, on Thursday, I believe it was like February 4th, the market has shown like a lot of weakness, and there was like a volatility spike. So then there was like a lot of, I was like kind of scared. And then in the morning, from like 9 to like 12:30, the everything was like pretty stable. Like the market was up a little bit, and my cousin actually sent me a message on Facebook saying, oh, I guess because he like sold his shares, and he's rather so close out his options, and he said, oh, I guess I got scared for like nothing. And then I took the flight to Cartagena at like 12:30 or 1, and then from like what happened while I was in the air and like getting to like the Airbnb or the hotel. It was only, because the flight's only like 2.5 hours, but then collecting all everything from the luggage. When I finally got internet access and I logged on, I got like a massive number of messages, and then I logged into my account, and I had like a $400,000 loss in just like 2 hours. And a massive like sell off, a huge spike in volatility. I think that the VIX at that time like increased to like over 50. Which was pretty high, because at the time it was trading like very low, like in the teens. So you had a spike in volatility by about like over 3x. So yeah, that was like and I remember making a YouTube video, and I was like kind of like defiant, like, okay, like I'll make everything back in like 3 or 4 months. And I did, but I think that I trade differently now, because now it's all about like avoidance, and I should never be in that situation where I can lose that much money in like a short period of time. So it's kind of like, okay, great. I was in a position where I made everything back in like a few months, like no problem, right? But I don't want to be in that position anymore. So I'd rather like trade smaller. And I think now, if a similar situation happened, maybe I wouldn't even lose anything. Maybe I would be able to capitalize upon a volatility spike. And instead of like playing from behind, where I'm like, oh, okay, I lost this much, now I have to make it back. Instead, maybe it will be something similar to the Amazon position, which I explained, which we discussed earlier, where it's like my positions expired, they expired worthless, so I made money. And now Amazon is trading at 32.50, where previously it was trading at 3,700, and none of my positions are being challenged. This is an amazing opportunity, because there's high implied volatility rank on Amazon, and I'm not dealing with the stress, and I'm actually profiting from it. And that actually ties back into the question previously about why I don't sell more aggressive deltas, because I just don't want to deal with stress.
Perfect. Yeah, that makes a lot of sense. So couple of last questions just to wrap things up. First off is people are asking about your course and whether they need to do the course first in order to be able to follow your alerts. And I told them, no, you don't. I followed the alerts without doing the course. Maybe it would help if they're complete beginners to this, but I don't think they need the course to follow the alerts. I picked it up pretty quickly, so it was pretty good.
But you also have a lot of experience. I think if you do have experience from trading options, then you don't need it. But there are some people who take the alerts who they get lost because they've never sold an option before.
Right.
And in that situation, it would probably save a lot of time to take the course. But in general, if you do have options trading experience, then my recommendation would be just to take like the 7-day trial. And I know like you have an affiliate link for that you can take it through you. Just to take the 7 days because it's cheap. It's like $19, and then they can ascertain whether whether they follow it and whether they understand it. And if they do, then yeah, I don't think that they need the course.
Cool. Let me just check. I think we're done. Yeah, the last one is account size. I'm sure you get this all the time. One guy's asking, is 50,000 account size good enough? My guess is yes, right? I think I was doing it with that. So yeah.
Yeah, that's a great question. I think so remember kind of like what we were talking about before about expectations regarding volatility, right? So on average, we target a return of about 3%. And the math just kind of like works out that way. Like the way that I trade, if I'm trading in the right way, then over the long term, I'm going to see about like 3% return on a monthly basis. However, if volatility is really low, then that might be like 1.5% or 2%. So obviously, if you are investing or you're subscribing to a system, you want to cover the monthly fee, and you also want to make money while you also want to learn, with the hope of in the future being able to do this by yourself. And I think that all of those concerns are really fair because that should be your goal, right? Like you should be self-sufficient. So I think that 50,000, yeah, it definitely makes sense. I think where the break-even point is, if you have like high volatility, then it would be around like $10,000 or $15,000. If you have low volatility, like we've had like over the past 2 months, then maybe the break-even point is going to be maybe even as high as like $30,000. So I think doing the math that way, but also I think for people who know that selling option premium is something that they want to do, I think it's completely okay to take the alerts for like 1 or 2 months, even if you have like $5,000 or $10,000, to study the trades and to try to replicate the trades and try to understand why I made a specific trade, and then cancel it and then trade on your own. Because if you have $10,000 or $5,000, then it really doesn't make sense to subscribe long term. It doesn't. Some people do. Some people subscribe long term with like $10,000 or $15,000. Yes, they do. And to be honest, it kind of like surprises me a little bit why they do it, because maybe they're making like a little bit, but they're not really like making that much.
It's like a learning curve, right? Learning from somebody who knows what they're doing, even if they lose a little bit because of the subscription fees and stuff. Who cares if they're learning from somebody like you that's been doing this for a decade or almost 2 decades, at least in the industry for that long? I mean, it's better than losing all your money to the market, right?
Yeah.
So yeah. All right. Well, I think that's it. Oh, I had one last question for you, and it's a question that I had because I'm interested in. Let me just find it. I think it was. So I know you've been in the sort of money making entrepreneurship outside of trading as well for quite a while. So I try and ask everybody who's been successful making money outside of trading, what's the number one tip that you would give somebody if they're looking to grow their wealth, not just through trading and things as well? So I was wondering what your thoughts on that would be.
My answer would be really to like take care of your health and like not compare yourself to other people, because there's always going to be someone who makes more money. And I'm guilty of this too. Like I was texting my wife like on WhatsApp, like, like I should have like started a private equity firm, and and like something like Apollo or KKR, and I would be a lot wealthier now than I am. But the reason that I left Wall Street in the beginning was that I just hated my job, and I was like so depressed, and I just hated myself. And you know, it is kind of funny when people. I occasionally like receive an email and they're like, "Oh, if you're so good, you would open up a hedge fund," but they don't understand. Like I've been there. Like I've spoken at hedge funds. I've done deals with like private equity firms and hedge funds. That I don't want to do that because, like, when you're a hedge fund, you're essentially like a glorified asset manager where all you're trying to do is like increase your assets under management, and you know, you're trying to like get around like SEC guidelines about like not being able to market yourself and do things in like a surreptitious way. But to go back and like more specifically, I think that I would have applied less pressure to myself to like be the best, and I would have focused more on the long term, because I think that from the stress that I endured and like things that I did in my early 20s, um, I like really like sold myself short for like short-term gains. And there are prices to pay. Like if you go out and you party and you drink a lot, or you like take a lot of like, you know, some of the antidepressants are like kind of can be like pretty toxic to your body. Like others, in my opinion, like from personal experience, like Wellbutrin are like pretty good. But then there are others which are like fluoridated and you know, and they also like tend to mess with the chemicals and like your brain chemistry, which I know from my personal experience that kind of like decreased my working memory and my ability to remember things and even to speak fluently for probably a good like 2 or 3 years. And then I had to like
motivation as well, right? Sometimes they were just motivation and things. So yeah,
like things, it can really mess with that. And I think that you would be much better off, or at least, you know, I can't really speak to like you, the viewer, because I'm not in your shoes, but I can speak from my personal experience. I would have been much better off if I would actually have been less ambitious and felt less pressure, and just focused on, you know, okay, like slow and steady is better than you know, trying to make as much as possible in the short term and burn yourself out.
So I've been the same. So I've been on antidepressants, and I actually have bipolar as well. And I've made so many mistakes over the years chasing fast money, like business deals and things, where my judgment's been off, whether it's been going on a new medication or not being medicated. And I've set myself back a lot and put a lot of stress on myself by not having that judgment, really, I guess. But I'm doing a lot better now, so my trend has improved because I'm much more stable. I don't make rash decisions and things as much. But I totally agree. I think being careful with that stuff is super important. So yeah.
And I think the viewer should really look at like two people, you know, both of us who have openly been on like medication, like pretty powerful medication. And remember that for every one of us, there are a lot of people who they're unable to overcome it. They're unable to like get off the medication, or maybe, you know, maybe a lot of people they're still on medication, but they're doing much better, where they're able to like, they found like a combination drug therapy, or they found medication that doesn't have the negative side effects, because some drugs your body interacts with differently than others. So in that situation, look at us as we're speaking for probably, for every one of us, there's probably like a few hundred people who didn't have the good fortune or the ability to like get off the meds and to do something constructive. Like there are many people who, you know, they get worse as they get older, or their symptoms get worse, or they're on more powerful medication. And not to judge them or not to think less of them, but really to try to take measures to prevent that from happening and to prevent yourself from having to be on medication in the beginning. And from my experience, the best way of doing that is, you know, not really comparing yourself, not burning the candle on both ends, not burning yourself into the ground, trying to mitigate your stress, trying to do like healthy things by eating well, limiting the sugar, going to the gym, you know, potentially if you have access to like a sauna or a cold plunge or something like that, you know, or just jumping in the lake if it's cold, like just things like that, like taking care of yourself, I think is probably like the best way that in the long term you can be successful and make more money, is just to take care of yourself.
Yeah, I totally agree, and that's awesome advice. So, yeah, so I think unless you have anything else to add, I think I'm pretty much covered everything I was hoping to talk to you about.
No, I
But
think it's a great talk, and thank you so much for having me.
yeah,
And
and thanks for your time. It's been good. So yeah.
appreciate it.
All right, cool. Well, I'll talk to you soon. Hopefully, we can touch base and you know, maybe we can even do another one of these more specific, depending on other people's questions from this interview. So I'll be sharing this on my YouTube and in my Facebook group and my blogs and everything. So I think you give a lot of value there. So
Thank you.
yeah,
Yeah, it's on my channel as well. Thank you so much, Russell. I hope you enjoy the rest of your weekend.
yeah, you too. Thank you. Thanks.
Take
Bye.
care.
You too. Thanks.